good afternoon, everybody. We're going to go ahead and get started today. And this is the second to last session of our May retirement series. Today's session is turning assets into income, retirement income planning. So thank you for joining us. And a couple of housekeeping details before we get started. My name is Terry Hecker. I'm a wellness and benefits consultant for MCW. We also have with us Mark Lash and Celeste Miller from our retirement 403B area at MCW. And I will be introducing Michael in just a moment. I just want to let you know everyone is muted upon entry. So if you have any questions, we ask that you please put them in the chat or the Q&A, and we will be addressing your questions at the end of the session. But I hope you've been enjoying the sessions we've had this May. Our goal is to help you be prepared for retirement. So today we have with us Michael Olszewski. He is a retirement planning consultant for Transamerica, and he is actually a dedicated consultant and does part of his time for MCW. So he is available for, he used to be on site, but he is available for telephone or Zoom sessions. If you would like to meet with him, you can schedule time with him on the 403B retirement site that's on InfoScope. So Michael, I'm going to turn the reins over to you, and then we will get started with the presentation today.
All right, thanks, Terry. I'll pull up the presentation here in just a second, but I want to thank everyone for your time and for joining me today and joining us today. Again, my name is Michael Olszewski. I've been on the plan for coming up now on, I'm in my 6th year, going on my 6th year. So I'm really excited to be part of your team. I've helped thousands of people with their retirement planning since I began. I've met the best people I could imagine, and I couldn't be prouder to work for MCW. You have a great retirement plan, some great people working on the plan too. So thanks for your time and attention. I'm going to pull up my screen here. Just one second, and Terry, if you could just give me a thumbs up that you can see the first slide. All right, very good. So as I mentioned, I help people with retirement planning. I do that every day. In response to that, Transamerica does do a number of presentations throughout the year on various topics surrounding retirement planning. So today's topic is turning assets into income, a guide to retirement income planning. Why is that important? The reality is at some point, we're all going to retire. We're no longer going to be receiving a paycheck, and we need to think about the things that we should be doing now and in the future to create that paycheck when we're no longer working. So in response to that, this is one of Transamerica's newest and greatest presentations, turning assets into income. A little bit of housekeeping, as Terry mentioned, I do work from home like many of you. Welcome to my kitchen. With working from my kitchen does involve a few interruptions from here and there, so I want to apologize in advance for those. Also, as Terry mentioned, you're all on mute. Put your questions in the chat. We'll get plenty of time at the end to answer them. Hopefully, I will get through a lot of those questions within the content of this presentation as well. I do want to leave or start with a quote or a proverb. If you fail to plan, you are planning to fail, of course. If you fail to plan, you're planning to fail. I think what you'll find throughout this entire presentation is the theme of having a plan. We realize that everyone's situation is unique. Everyone's retirement plan and retirement planning, the things they have, like the ingredients towards their retirement plan, are also unique. But the very one thing that kind of draws everyone and to the same goal of planning is retirement and having a plan for retirement. So if you fail to plan, you're planning to fail. So throughout this, I hope you notice the theme of having a plan and setting that plan into motion as you near retirement. Whenever you work with Transamerica and our retirement planning, you'll find that we always talk about the 5 key areas. We consider these the 5 essential areas of retirement planning. Each of them is different from one another, but it's often hard to talk about just one without talking about the others. So to go through those 5 key areas first, we're going to cover, we'll talk about lifestyle. And really, lifestyle is how you can make the most of your retirement. It's also the way you want to spend your retirement. Uh, what I've noticed working at MCW is that retirement is different for just about everyone. Some people retire into another career. Some people retire into their couch. Whatever it is, whatever your lifestyle, whatever you want to do in retirement, that's up to you. But you do want to make sure that you have the means to cover it. So we're going to talk about next, income. So how much do you really need to live your lifestyle? What resources do you have to create that income? And again, that'll be the main focus of today's conversation. We will touch on some of the other subjects just in the context of income, but today's main focus will be on how much we're going to need and where that money's going to come from. Legacy planning is also important. We want to make sure that everyone we talk with has a plan to safeguard their financial legacy, to make sure that that money that you've saved and earned throughout your career will go to the people you want it to, at least if that's a goal of yours. Now, investments, most of the time I think people think that when they talk with me, that's the first or the only thing they're going to talk about. A lot of times it's the last thing we talk about, but investments is basically how are your assets allocated for long-term stability? How is your money allocated? How are you generating income to keep up with inflation? We'll talk about your investments briefly, but just know that in a brief 30-minute conversation with me after this presentation, I'm happy to cover those in great detail. And lastly, healthcare. And we work in the healthcare field, many of you do, or all of you do, and it's important to each and every one of us to understand our healthcare plans, to make sure they sync up with our wealth plan or how we're spending money, make sure we're signing up for Medicare when we need to, make sure we're planning for the costs of healthcare throughout retirement. So those are the 5 key areas of retirement planning that you will hear us talking about in just about every conversation you have with Transamerica. So let's talk a little bit about how each and every one of you visualize your retirement. The survey that you see on the screen here was basically just some questions that they asked retired people or people coming up on retirement of how they wanted to spend their time. I think the reality is that people are spending time being more active than ever before. They're also living longer than ever before. Over 2/3 of the people in the survey said that they wanted to travel in retirement. Almost half of the people said they wanted to pursue hobbies. Those things cost money, and having a plan to make sure you can pursue your hobbies and travel in retirement is going to be paramount if it's a goal of yours. The interesting thing is that almost 30% of people said that they were going to work or do some sort of additional work in retirement. We're seeing more of that than ever before at Transamerica, as people actually retiring to another career, possibly starting their own business, or continuing in their same field, just doing something completely different. Anyone that knows my wife knows that she wants to work at Petco for her 50+ year point of her career. I said, fine, save some money now. You can work at Petco and pet all the dogs and cats you want your entire day. But whether you plan on working another career or whether you plan on just traveling or pursuing hobbies or whatever it is, we're going to talk about the ways that you can make sure that those goals become a reality. So planning for retirement income, most people want several things. They want independence. They want to make sure that they're not relying on their family, that they've saved enough to support the lifestyle they want to live. They want to make sure that they're secure. Obviously, no one wants to lose their house. No one wants to run out of money. Having enough saved will give you the security that you can be in the spot you want to be in. Freedom is also important for retirees. Basically, freedom to do what you want or not do what you don't want to do. That's an important piece of everyone's retirement plan. And flexibility. It's important to have the flexibility to know that you can make changes to your retirement plan if you need to. And you probably will. Most people's plans over time change quite a bit. The reality is, in retirement, what we want and what we get is a little different. What we have in retirement is income. We need to create an income source. We need to make sure that we're creating that paycheck when we're no longer receiving it. Retirement is also a time when we have to focus on our expenses. Yes, you have all this money saved, but equally important is how much are you spending every month? What are those things that are the needs versus the wants and the wishes? And basically, how do you organize your expenses in retirement? Retirement also has a little bit of uncertainty. Everyone's retirement picture is different. I think most retirees would agree that how they are living in retirement and what they expected is probably a little different. So with that uncertainty comes some questions, and hopefully we'll be able to answer a lot of those questions just simply by having a plan to retire. How do we close the gap between what we want and what we have? Well, we're going to talk about doing that today throughout this presentation. Having a plan is critical. I think we can all agree. Regardless of how much you have saved for retirement, everyone needs a retirement income plan. Why? Because even with planning, nothing's perfect. And having a plan will help you address the risks inherent to any retirement income plan. It'll help you create a sustainable stream of income to meet your needs over the course of your retirement. It'll also help you address the needs for flexibility to accommodate uncertainty and changes. So again, I think it's important to recognize that for all these reasons we talked about, having a plan is the most important part of retirement planning. So today's goals. Today I want to make sure that we review the risks inherent to any retirement income plan. We want to talk about those risks, and we want to make sure that we're thinking about them throughout. We want to walk through the 5 key steps that we believe will help you build an income plan. And we also want to provide clarity and confidence in building an income plan that's right for each of you. I'm going to cover these today. If I miss something or if you have something specific to you, let's meet at the end of the presentation. I'll let you know how to schedule a meeting with me at a time that works best for you. So I mentioned that there are some risks in retirement. There's risks in everything, but the risks that are specific to retirement are longevity, inflation, market volatility, and just general uncertainty. All of these risks are things that with a little bit of planning, you'll definitely have answers to and you can minimize throughout your retirement, but we're going to at least talk about them in a bit more detail. Now, longevity. The reality is people are living longer than ever before. That's fantastic. I mean, that's really a positive thing. Why wouldn't everyone want to have a wonderful retirement? But with a nice long retirement comes the expectation that your money needs to last that long also. The reality is that 1 out of every 3 65-year-olds today is going to live past 90. 1 out of every 7 65-year-olds today will live past 95. That's amazing. I think we can each think about at least a couple people in our lives that are living into their 80s and 90s happily. And each of them had to do some planning to get there. Keep in mind that because of longevity, we want to make sure we plan for a good long life, and we want to make sure that our money lasts as long as we do. Inflation. Another important thing to consider throughout our retirement planning is inflation. Yes, we know that the average rate of inflation historically has been about 3%, but it certainly hasn't been a very smooth ride. We've seen inflation upwards of 4 or 5%, and the last few years we've seen very low inflation, and that'll change throughout everyone's career. But really, what is inflation? It's just the erosion of purchasing power. It's the idea that that dollar in 1988 is not going to buy nearly the same thing that that dollar is going to buy in 2017. So because of inflation, because the purchasing power of our money generally goes down over time, we need to think about ways to make up for that inflation with investing prudently, with taking guaranteed investments when needed, and just protecting what we have saved throughout our retirement. Market volatility is also a big risk. Market volatility really just means that the market is going to be unpredictable. We know that. Over time, history at least has shown that the markets should trend upward, and we have seen returns of 7 to 8% a year on average for long periods of time. But that assumes a few things. That assumes that you're invested 100% in the stock market. The reality is that most people shouldn't be invested 100% in the stock market as they're nearing retirement. Because of that, you wouldn't expect to get full market returns. Also, I think as this chart shows, those returns aren't a smooth ride either. There's going to be a lot of great years and there's going to be a lot of years that aren't so great in the market. Yes, we want to get a good average over time, but just know that market volatility is a risk for everyone, especially people closer to retirement. And then there's also those general uncertainties, those things that may not go according to plan or simply may change as you are in retirement and realize the realities of retirement. A couple of those things that are uncertain: varying income scenarios. Maybe you're thinking about a phased out retirement. It's pretty popular these days. You know, I can't tell you how many people I've spoke with that going part-time, going 4 days a week, then 3 days a week, then 2 days a week. And if your job allows you to do that, fantastic. Timing of income can also be a challenge, at least an uncertainty. Depending on where your income is coming from, depending on how old you are, timing of that income may be a question mark in your world. And also loss of income, whether it's a spouse also retiring or whether it's just simply not working and a decrease in pay. A loss of income can certainly be an uncertainty in retirement. Changes in expenses or taxes can also be a major point of uncertainty. We're going to see inflation. We know that. I think we've heard it on the news now a lot, and we're probably going to hear a lot more of it. But inflation, that general idea of your dollar not buying as much as it will in the future, that creates a little bit of uncertainty on what things will cost later down the road. Same with healthcare. We all know that those costs change, and I would expect they will change over time. There's always the general emergencies that nobody can plan for, but they certainly cost money. Tax rates, that's always a wild card also. Your tax codes can change often, and they do. Those tax brackets, I've seen them change a number of times in my life, and I'd expect that they will continue to do that. And also those deductions or things that you have that can come off of your tax bill, those change every year as well. So best I can say is not just having a plan, but also having a couple important planners in your life. Have a good tax person in your life that can help you not just with your current taxes, but with your tax planning for the future. And have a financial planner in your life, whether it's me with Transamerica or somebody that you trust. I hope that you trust Transamerica at this point. Please talk to me if you have questions. So let's talk about what goes into developing a plan. Now that we've realized it's important to have one, let's talk about creating one and really building it out. There are 5 key steps that we feel everyone should take when creating a financial plan. First, you need to estimate your expenses in retirement. It's important to know what you want your expenses to be and what your expenses will be in retirement. We realize those things can change. You can always update them, but at least having a plan is important. Identify your sources of retirement income. So we know that most of us will have Social Security, but what else might be out there in regards to retirement income? I want to help you calculate the income gap between your reliable sources of income and your overall income needs. We want to fill the gap. We want to fill that gap. So once we identify that how much money you need, we want to fill it with as many sustainable income sources as we can. We want to create as much sustainable income to kind of cover your most important expenses. And lastly, we want to monitor and update our plan periodically. So with every good plan, it's important to review things. It's not out of the question to have an annual meeting with your financial planner, and you definitely should be having an annual meeting with your tax planner just to make sure that all of this stuff is working the direction that you want it to be working. Now, the first step, again, is identifying your expenses, creating an estimate of your expenses. I think that since I've been working here, I've heard this called a number of different things because most people don't want to call it a budget worksheet. I've heard it called a dream worksheet or a cost of living worksheet. However you view this exercise, creating a budget is of utmost importance now and when you're retired. I realize that it's not the most fun exercise for some people, but just know that it can be painless. I think the best way that I would say to build a budget is start by building a budget that's your dream budget, or how you really would love to see your retirement. Why not? It's easy to think about those pie in the sky ideas of traveling or spending money on expensive hobbies, whatever the case may be. Create your dream budget. Maybe next create a budget that's not so much your dream. Maybe the tighten the shoestrings budget, we'll call it. Understand which expenses you can eliminate or remove off of this is important. Now, lastly, if you did do those other two exercises, is create your current budget. Make sure you have a good idea of what your expenses are right now. The budget worksheet you see on the screen here is the one that Transamerica developed. You can get it on transamerica.com/GRTR for Get Ready to Retire. I think the cool thing about this budget worksheet is it does divide things up by essential and discretionary. And I realize that there's some gray area there. What's essential to me might not be essential to somebody else, and vice versa. But regardless, it does a pretty good job of categorizing things as essential, the ones that you need to make sure you're paying all the time, and then discretionary, those things like eating out, charitable giving, where, well, it may be important, you may be able to eliminate it if need be. So if you need this budget worksheet, reach out to me. Please, I can send it to you anytime. I can help you fill it out even if you'd like. But I think having an idea of your expenses as being step one is one of the probably the most important piece of this process. In response to expenses, or as a comment on expenses, I do want to point out that it's important to not forget about healthcare. Typically, Medicare does not cover all of your healthcare expenses in retirement. We hope that it covers quite a bit, but the reality is that there's generally some out-of-cost expenses. It's also important to identify when you should be enrolling. You want to make sure you enroll at the appropriate time so you're not paying extra penalties or fees along the way. It's also important to know how much your premiums are going to cost, whether or not those premiums are going to be paid for through your Social Security or out of pocket. How much will your supplemental insurance cost if you decide to use a supplemental plan? And how much should you budget for general out-of-pocket expenses? Now, one of the great resources out there is Medicare.gov. It's a surprisingly easy website for being a government website. I think they do a great job of just helping people answer the questions they need to about Medicare. Also, I will mention that Transamerica does have a company that we partnered with called SelectQuote. SelectQuote is a company that will give you quotes and estimates on your healthcare costs. And you don't have to be 65 to use them. If you're retiring before 65, if you're looking for private insurance prior to retirement, or if you're looking for Medicare planning, you can call SelectQuote, tell them that you work with Transamerica or you work for a company that uses Transamerica, and you'll be able to get some quotes from them. Reach out to me if you want their information, but just remember to budget for some healthcare expenses when you start going through those worksheets. All right, so I want to move on to step two. Step two is identifying sources of income. And this is the first time you're going to kind of see this stacking graphic, and we're going to add to this as we go through the presentation. But in the identifying sources of income area, we're going to try to identify types of income. We organize this from the bottom being the most sustainable, the most guaranteed, and the income that should pay you for your entire life. So Social Security is going to pay you for as long as you're around. Having a pension through an employer typically will pay you for as long as you're around otherwise. So those two being at the bottom, the foundation for your sources of income. Above that, you're going to find your retirement accounts, your savings and investments outside of MCW, and maybe employment. We consider those discretionary income sources. The reason those are discretionary is because they can change, they can fluctuate. If you're not working, you're not going to get that paycheck, or you might not be getting the same amount that you were before. The balance in your savings can change depending on what you spend out of it and the needs there. And certainly with your retirement accounts, if they're invested in the market, there's going to be some variability with the balance as well. So you'll find that those reliable income sources are going to be those pension and Social Security, and those discretionary income sources are going to be almost everything else, your employment, savings and investments, and your retirement accounts. So we talked about those reliable sources of income being Social Security and pension. A couple things that are important to realize or think about with Social Security is eligibility. First, you have to be eligible. For most people who've been working most of their lives, being eligible is not a challenge. But if you're new to the working world, or if you just haven't worked for whatever reason, just know that you have to work at least 40 quarters. That's 10 years to be eligible for Social Security. Within a quarter, you just have to earn somewhere above $1,500. That's not an exact number, but just know that it's pretty easy to get eligibility for a quarter, and you have to have 40 quarters or 10 years in the workforce to be eligible for Social Security. Primary insurance amount is also an important thing to realize because not everyone gets the same amount from Social Security. The primary insurance amount is the amount, your 100% amount that you'll receive at your full retirement age. Now, your full retirement age is not the age that you have to take Social Security. You could take it earlier, you could take it later. Typically, you could take it as early as 62 and as late as 70, and there are increases. But your primary insurance amount is that amount that you'll receive at your full retirement age. And for increasingly more people, full retirement age is 67 years old. But you can also check based on your birthday on the Social Security website, ssa.gov. Or if you attend one of my Social Security seminars in the future, or just reach out to me, I can get you that information as well. Also with Social Security, it's important to recognize that there is an impact of working in retirement. So if you're under full retirement age, they're going to withhold some of your Social Security benefit if you're claiming it and working. So after full retirement age, you can work as much as you want, but before full retirement age, they're going to withhold some of your Social Security benefit if you make too much money. And too much money is somewhere around $17,000. So after that point, they're going to start withholding your benefit. You can get all the exact numbers and all the detailed information by going to ssa.gov or reach out to me, and I'm happy to answer questions on Social Security. With the reliable sources of income, the other one that we've talked about briefly is pensions. If you have a pension from a former employer, that's fantastic. That's a monthly payment that they're promising you at some certain point. Questions you should be asking yourself, though, is how much is that monthly payment and when is that monthly payment available? What are the payout options as well? Because most of the time with pensions, they're going to provide a number of different payout options depending on if you're married or not, depending on if you want to guarantee a certain number of payments. So just understand that pension, understand when it pays you money, and how you can incorporate that into your financial plan. Now, let's talk briefly about those discretionary sources of income. Those are equally as important. Those are going to be supplementing your income as well in retirement. First and most important are going to be, at least in my world, most important is going to be employer-sponsored retirement plans, like your MCW 403B. That's a fantastic way to save. It's the way that most people are saving right now in the workforce, and your MCW 403B is going to be a great resource for you to provide supplementary income in retirement, discretionary because the value can fluctuate. Same with an IRA. An IRA is going to be very similar to your 403B, but the IRA is an individual retirement account. It's an account in your name. Maybe it's from a former employer, or it's from contributions, but those IRAs are going to be also available to you for discretionary funds. If you've saved outside of your work plans and outside of the retirement system, you may have personal investments as well. Those can often be tapped into or used to help you supplement your retirement income, just like general savings can. And as we talked throughout this entire presentation, we will always consider wages as discretionary source of income because it's certainly up to you if you want to earn that salary in retirement or not. So to build on this idea of creating an income plan and the sources available to each of us,
it's important to match the sources of income with the expenses. What we have along the right and what we've incorporated now is expenses, and we've organized them at the bottom as the most important and the top for most people being least important. What you'll find at the bottom is healthcare expenses being very important. We want to make sure we're covering those. I think that's an easy way to make sure that we're not blindsided by huge bills later on in retirement. Next above that is essential expenses. We talked about those on the budget worksheet. Those essential expenses are really the ones that are going to keep you warm, dry, and fed, keep those bills paid, keep your lights on, to make sure that you're covering your essential expenses and your healthcare costs. We want to make sure normally, if we can, we want to cover those with reliable income sources. Above that is going to be your discretionary expenses. Call that your fun money, or those are the expenses that you may be able to reduce if needed, but those are the ones that keep us all happy and make life exciting. So it's important to plan for those and have those as part of your retirement picture. Freedom and flexibility, I think this is interesting that we keep this as a category, put this as a category. Really what that means is that's going to be money for those larger than normal expenses. So discretionary expenses are your day-to-days, but your freedom and flexibility expenses are really if you want to take a big trip with your family, or if you have had a dream sports car that's attainable and you'd like to buy it. Having the freedom and flexibility to buy those things is important for a lot of people. If it's important to you, put it as part of your budget, put it as one of your expenses in retirement. And lastly, legacy. Legacy is the idea that you may want to give some of this money to your children, to your grandchildren, to your favorite charity. If you want to create a legacy, if it's important for you to have some money left over, plan for that as well. Because having that as part of your budget and having that as part of your expenses will ensure that it happens, and it happens exactly how you want it to. As you can see how this is organized, I know I said it earlier, but your healthcare and your essential expenses, in a perfect world, we want those covered by reliable income sources. Your discretionary expenses, your freedom, your flexibility, and your legacy, all of those can and normally are covered by your discretionary income sources. By building your foundation this way, you're making sure that all of your essentials and your healthcare are covered with monthly payments that you're never going to outlive. And then all that rest of the stuff that you can adjust accordingly, you can use that with your supplementary income from either employment or savings or retirement savings. I mentioned a step 3 of calculating the income gap. Now that's important because we recognize that most people are going to need a little extra after they look at their reliable income. Almost everyone. I think it's important to point out that especially Social Security, it was never designed to pay 100% of your salary. It's typically only going to cover 30 to 40%. So your reliable income like pension and Social Security, first you want to calculate how much that's going to be. In the example here, this person has reliable income sources of $2,500 per month. That's pretty good. So their Social Security and any pension that they have is $2,500 a month. This person also has $5,500 a month of monthly expenses. So to calculate an income gap, you take that $5,500 monthly expense, subtract that reliable income that you know you're going to have from Social Security and pension, and what's left is what we call the income gap. And in this example, that's $3,000 a month or $36,000 per year. Now, $3,000 a month, where's that going to come from? Well, it's going to come from your savings, from your investments. What's it going to cover? In a perfect world, we hope that it covers your discretionary expenses, those freedom and flexibility expenses, and your legacy. What you'll find here is that depending on how much your healthcare and your essential expenses are, you may need to be using some of your retirement savings to supplement that. But at least having a good understanding of what your income gap is important, because over time you can kind of plan for replacing that much income. Transamerica does have a tool on our website called OnTrack, and it uses this same idea of income gap or income surplus. It creates a goal of how much you need, and then it also creates an amount that it thinks you're going to have, and the difference between those two is going to be that gap or that surplus. So creating an income gap is important for everyone. If you don't have a gap, if you have more reliable income than you need, fantastic. And it's also important here to recognize that having a good budget in retirement can really make this a easier process as well. So if you have any questions about calculating your specific income gap, or if you need help doing it, please let me know. I'm happy to work with you on it. Now, when it comes to retirement income, there's essentially three solutions. So we have to think about filling this income gap. We know that that's step 4. So once we've realized that we have this gap, how do we fill it? Well, there's a few sources, and depending on the source you use, it's basically going to give you either some flexibility or sustainability. Now, flexibility is going to be just that, the ability to take money out when you need it, to have access to money when you want it. Your traditional investments like your IRA, your workplace plans, they're very flexible. Once you're retirement age, you can take money out without any penalty. All you have to do is pay taxes typically on your withdrawals. So it's flexible, yes, but is it sustainable? No, not necessarily. The reason it's not sustainable is because if you spend all the money in your MCW 403B, it's gone. That's it. I think most people know that, but it's important to at least say that out loud. Now, on the other end of things is sustainable investments. Sustainable investments are things like immediate annuities. An immediate annuity is really basically the equivalent of you taking a portion of your retirement and turning it into a monthly payment for life. An immediate annuity is sustainable. It's going to last as long as you are. But once you turn that money over to the insurance company, there's really not a lot of flexibility. You lose a lot of access to it, and because of that, usually you'll get a little bit better monthly payment on an immediate annuity, but you lose a lot of flexibility. So I do just want to introduce you to the idea of flexible assets like your traditional investments, sustainable assets like an immediate annuity, and just know that there are some products, some guaranteed income products in the middle that have some flexibility along the way. So with that said, step 4, filling the income gap. Let's talk about the general rule of a 4% withdrawal rate. The question of how much can a person withdraw each year and not run out of money. Now in the 90s, the 4% rule became a common rule of thumb. It's by no means a law or something that works for everyone, but basically the idea of a 4% withdrawal rate is that in retirement, your initial withdrawal should be 4%, and then every year you increase it just a small amount by inflation. So over time, what the calculations saw for a lot of people is that historically, if people were to do this, take 4% and then add inflation every year, it would offer a high probability that their assets are going to last as long as they do. And even when I'm talking to young people or just about anyone planning for retirement, it's real easy to at least understand that about a 4% withdrawal can work for a lot of people in retirement, but it doesn't work for everyone. And a lot of research since the 90s has shown that the 4% rule might not work for just about everyone. Why? Well, I think the main thing is not everyone is invested the same, and not everyone spends money the same. This chart is really interesting because what it does is it talks about different spending strategies, whether you're going to take the same fixed amount out, whether you're going to take spending with a 2% cost of living every year, which might be conservative depending on where inflation is, or if you're going to do that 4% with an inflation adjustment. Now, depending on how your money's invested, that 4% might not be best for you. If you're, let's just take the inflation adjusted idea here. The 4% rule, this bottom row. Yes, it works. If you invest your money aggressively, you should be able to take 4.3% out. But not everyone wants to invest aggressively in retirement. Most people shouldn't. So if you're invested conservatively in retirement, all of a sudden your sustainable withdrawal rate becomes 1.9%, 1.91. It's a little different than 4. So I think just knowing that 4% is a good ballpark for calculating things, great. but it doesn't cover all of these scenarios. It might not cover your scenario as well. Just keep in mind that you may need to adjust your withdrawal rates depending on how you want to invest your money in retirement, or at least adjust your expectations of what you should expect to get out of your portfolio. I want to touch on guaranteed income products briefly. Guaranteed income products offer sustainable protection. Whenever you hear about guaranteed income products, normally we're talking about fixed and variable annuities. So historically, I think annuities have had a bad rap. But the nice thing about annuities is that they give you some guarantees by an insurance company. There's additional riders that often provide guaranteed income for life. That's the first most basic rider that everyone that has an annuity has, a monthly payment for life. So you're creating a personal pension by having an annuity. These riders aren't free though. There are additional options and additional riders that you can add, and there's fees involved. So if you're thinking about having an annuity as a way to supplement some of your income in retirement, what I will tell you is that read the fine print, work with a trusted financial advisor like Transamerica, and talk through what your options are for creating a future monthly payment for life with a fixed or variable annuity. It can be a part of just about every person's plan if used correctly. Now, single premium immediate annuities, we touched on those briefly in a previous slide. Those are also known as immediate annuities. They offer some sustainability protection. And again, it's the idea of turning over a portion of your portfolio to get a monthly payment for the rest of your life. And depending on how much you need, that's how much of your portfolio you turn over. It can be a good piece of everyone's or most people's retirement plan, but you never want to put all of your money in something like this either because you lose a lot of access to it. One of the nice things about a single premium immediate annuity, it's going to give you a higher guaranteed initial payout normally than other products. The reason is that you're turning over a portion of your portfolio, usually a larger dollar amount, and you oftentimes get a little bit of a premium for that. Remember, there's limited flexibility with these options. Once you do turn that into a monthly payment, you lose most access to that cash. And depending on the options you choose, there may or may not have or be any inflation protection either. So just like the previous annuities we spoke about, it's important to read all the rules. It's important to use these prudently and work with a financial advisor to see if there's a good fit for you to have some sort of guaranteed income coming from an annuity. Now to bring it all together here, how do these guaranteed products fit into our big equation of creating income in retirement? Well, as always, we have those reliable sources of income in the middle bottom area here. Those reliable sources of income in a perfect world are going to cover your healthcare and essential expenses. Those are going to be your Social Security and your pension. Now, if you need additional income to cover those healthcare or essential expenses, or if you also want to make sure your discretionary expenses are covered for your entire life, you may be able to carve a portion of your investments out, create an income for life stream by using an annuity. Oftentimes what I've seen is people calculate that income gap. People figure out how much of that gap they want to make sure is covered to keep them happy and give them a good peace of mind in retirement. Whatever that gap number is, use an annuity to pay that portion. Give you that peace of mind, give you that insurance that you're going to get a monthly payment for the rest of your life. At that point, if you need extra money, you can supplement it with your savings, with additional employment, but we hope that it'll cover a majority of the things that you want to spend money on in retirement. The important thing I think here is that creating an income plan is going to be specific to you, and you want to make sure that you're creating one that's right for you. There's going to be three primary components. First, we've talked a lot about that income floor, the idea of guaranteed income solutions that can supplement your reliable sources of income. So after you talk about your reliable sources of income like pension or Social Security, if there's a little bit more there that you want to make sure covered, we call that your income floor. That's where you can use those guaranteed income sources to give you that extra money for the rest of your life. Another component is going to be sustainability. You want to manage the amount you withdraw from your traditional income sources to make sure that money lasts as long as you need it to. So an early withdrawal out of account sometimes can be pretty detrimental later on. You want to figure out what the sustainable withdrawal rate is for you and work on taking just that amount if possible out of your investments. Lastly, is going to be balance, that balance of flexibility versus sustainability. I mentioned that you would never want to put all of your money in any one product usually, for the most part. You want to make sure you keep some money flexible and accessible and liquid if you need it. And you want to also have as much guarantees as you need to make you comfortable and make sure you're covering all of your essential expenses if possible. And remember that as life changes, your retirement income plan is going to change as well. We know that, we understand that. If you have a change in your retirement goals, if you have your decrease or increase in expenses, maybe you sized down or sized up a house, whatever the case may be, investment performance can also change your outlook as well. Changes in legacy desires, if say you have children, you wanted to originally give them a bunch of money in your passing, but your children are very successful now, your legacy desires might change because of that. Also, taxes are going to impact things a lot too over time, and as taxes change, so too will your retirement plan. I mentioned this earlier, but consider working with a financial professional to help make sure that your goals, your ever-changing goals, are written out, you have a plan for them, and that you're working towards them. As we've gone through this presentation, I've covered those 5 key steps. I do just want to review them briefly. Remember, you need to estimate your expected expenses in retirement. We have a budget worksheet for that. You want to identify income sources and how reliable they are. You want to calculate your income gap and address that gap. So if you need some extra money, how are you going to cover it? You want to consider the different approaches to filling that gap, whether it's drawing down your portfolio, whether it's using some sort of annuity product to cover that additional expense that you need. And you want to make sure you're monitoring and updating your plan periodically. Here is my contact information. You know that you can find this out on InfoScope as well. Otherwise, pull your phone out, point it towards that QR code. It'll take you right to my calendar. You can schedule a meeting right away. Or you can always go to transamerica.com/portal/MCW as well and scroll to the bottom. You'll see a link to my calendar. Here's our disclosures. I'm not going to read them, but I will just point out that I am a financial professional. I'm not a tax professional. So get one of those in your life. They're a great person to have, a great resource to have with your planning. This information was provided as educational, and please reach out to me if you have any questions. Thank you for your time, and I'll turn it over to Terry, who is going to help field your questions in the chat.
Okay, wonderful, Michael. Thank you for all the information. It really gives you a minute to start to think through all of those different points you've made on your income sources. So that's super helpful to start to contemplate, especially if you're close to retirement, so you can plan. We have a number of questions. The first one I'll start with is, with looming huge government expenditures, many people are talking about a large correction in the market, which may far exceed the crash of 2008. Besides keeping a balanced portfolio and waiting it out, is there any particular actions we may want to take, particularly those close to retirement? So any suggestions on how to navigate it, to prepare for that?
Oh, sure. Yeah, that's $1 million question, I think, all the time, is what will happen with the market? Obviously, if you're closer to retirement, that's a bigger challenge. I think you took the words out of my mouth. I'll always go to a balanced portfolio and waiting it out. But in addition to that, I think having regular meetings with a financial planner like myself or somebody trusted in your life to make sure that your allocation makes sense for you at that moment is important. There's also some products available both at Transamerica and outside of Transamerica that can start to provide you some guarantees. So if you're over 59 and a half, you do have the ability to do an in-service withdrawal. You can take a portion of your 403b out and you can invest it differently.
So if you're looking for some guarantees, we talked about those annuity products that are out there. Whatever the case may be, there are products out there that'll provide guarantees, especially in a down market. So talk with me. I could get you introduced to the Transamerica Advice Center and see what's available. Also within your plan, there's a pretty nice option called the New York Life Guaranteed Investment. It does provide a guaranteed rate that only changes, I believe, every 6 months. So there is at least a nice option for guaranteed money. I am not going to be the person that can tell you when to time the market. I'm more of a long-term investor, and if you're just looking for advice on the portfolio, I'd say balanced portfolio and riding it out if and also talking about those other products available.
And how much is a financial plan through you for MCW employees? So I guess that's related to, they're wondering if there's a fee.
Sure. There's no fee. Yeah, basically Transamerica has what we call our advice center, and it's a team available to help you generate a plan, a more advanced plan than what the website, the OnTrack tool is going to provide. So most of the time, 2-3 years to retirement is kind of our sweet spot of helping people, because there's not a whole lot of planning that can be done. But there are things. So if you have questions, or if people have questions on building a more advanced plan, come talk with me. There's no charge for it at all. There's no pressure. It's not a sales pitch. It's just general good information. My colleague Brendel Kortman helps everyone at MCW that needs a plan like this, and it's just a 60-minute phone call to start the process.
And kind of related to that, can you help us if there are funds outside of Transamerica? So
we can help a couple of ways.
Yeah.
Oh, sorry, Terry.
No, go ahead.
Yeah, so we can always consider those assets. If you're happy with where they're at and you don't want to move them, we can always consider those assets as we plan for you. Ultimately, I think almost any financial planner that you talk with is going to say that it's easier to have that money in one spot, because we know how it's managed. We don't have to worry about somebody changing it over time without us knowing. So I can help you consolidate. I help thousands of people consolidate. And most of the time, almost in every case, it's a pretty big relief when people do move that money into one spot. But whatever the case is, if you leave it outside, we can help plan for it and just account for it. And if you need help consolidating and want a good spot for it, Transamerica is here to help also.
And once retired, does MCW still cover all of your services and advice to us, or does that end?
No, you can. I've talked with people that have been retired for years. I have a small fan base of people that they had a little bit of extra time before they retired to get to know me, and they still talk with me and send me emails. The services are still available to you at any point. Nothing really, or not a lot changes with your plan when people retire. You still pay that annual $48 fee. The 403B is managed by you, so it is self-directed, but if you need help, you can reach out to me and I can help you make changes. And ultimately, I can help introduce you to the products available at Transamerica if you want to move it out of the plan.
And next question, how can you find out if you're eligible for Social Security? My husband is a retired police officer and they do not put into Social Security.
The best resource is SSA.gov. I know it's a scary to go out to a website and expect that you're going to get the answer you want, but it is very easy to use. And even beyond that, there's a scheduling tool out there and you can meet with a person. There's offices around the area, and I've talked to a lot of people that have just scheduled a meeting and gone in and they'll be able to dig out all of somebody's old records. So more sooner than later, I would talk with them and see if there's a record, and hopefully if he's not eligible, he just needs to work a couple quarters and make a small amount of money each quarter if it's a possibility, and then he will be eligible. But SSA.gov, or just go right to the Social Security Administration office and schedule a meeting. Those are going to be the best things to do.
Yeah, and you can also print out your retirement statement out there. Every year on my birthday, I do that. It's not a great birthday gift, but
that's a funny thing to look at. Yeah. Nice.
It's the one time of year I can remember to do it. So I go out there and I print it just so I can see, it doesn't change drastically, but it's nice to know that the numbers are in line and it's a personalized statement. So it works nice. And I agree, it's a really nice resource. And their website has gotten way better over the years because it used to be really hard to find things and it's not anymore.
I agree with you
Um,
there. Yeah.
yeah. Um, if you have a pension at another company, can it be rolled into MCW or should you just leave it where it is? And they said pension. So that there might be rules there.
Yeah, I think that you hit it right on the head, Terry. Um, I think the first thing to do with that is to talk with the former employer and see what the options are with that pension. Sometimes there is a lump sum option available where you can roll it right into a retirement account. But you want to make sure that's right for you because pensions are it's a very valuable resource. It's, as you can tell from this presentation, it's the foundation of a very good plan to have money that you can outlive. So it's also a very big decision if you decide to roll a pension over because you're basically foregoing those benefits that they're promising you. But ultimately, call that company, see what the rules are. If there's a lump sum option, and if you're not interested in taking a monthly payment in the future, then yeah, if there's a lump sum option, you can roll it right into your MCW plan.
And does Transamerica require a certain distribution per year, like the required mandatory distributions?
So, so it's not a Transamerica requirement, but the IRS does require a distribution at age 72. So starting at age 72, if you're no longer working, you're required to take a certain portion of your portfolio out each year. You're not required to spend it, but you are required to take it out and pay taxes on it. So once, when you're about 71 and a half years old or so, we are going to send a message to you and help with that process. We'll let you know what the amount is and we'll give you options for either taking it out or letting us know that you took it out from somewhere else. But regardless, we'll start giving you some information later, in your early 70s when you're 71 in expectation of that required distribution at age 72. If you're working, you're not required to take a distribution, even if you're older than 72. So if you just work forever, you'll never have to take a required minimum distribution.
And there's a little bit about a Roth IRA. How do they fit into retirement? Can they be dipped into while you're still working or take out prior to Social Security? So can you access the Roth dollars? Where, when, and any limitations?
Okay, so with Roth dollars, there's two different types of Roth that we would talk about: a Roth IRA and your Roth 403b. A Roth IRA has its own rules. That's the one that you can put $6,000 or $7,000 away a year into. As long as you have that account open for 5 years, you can take your contributions out without penalty. So most of the time those are for retirement, and we would we'd always encourage people to to leave that money in as long as they can. The real benefit of the Roth is keeping it as long as you can because you never pay taxes on withdrawals. The Roth 403b, that's a component of your workplace plan, and that money follows a similar rule. There's a 5-year rule with your earnings, and be able to take your earnings without penalty. But the Roth within your 403b has a much higher limit and allows you to save right off of your payroll. Personally, and I think most financial planners will agree that it's important to have both types of money in retirement, pre-tax and Roth, because nobody really knows where taxes are going to go. And it allows you to really diversify your tax exposure. If you're retired and you don't want to pay more taxes, but you need some money, that's why that Roth is there. If you're retired and you don't need the Roth money right now, you can hold on to it as long as you can. There's no required distributions, and the longer you keep it, the better. So I hope that helps answer those questions about Roth, and I'm here for more specific stuff too if people want to reach out to me directly.
No, that was helpful because the Roth is fairly new, obviously, for MCW employees. They may have had it prior employers, but we haven't had it that long here at MCW. If annuities are set up for a guaranteed income, for example, 10-year annuity, and you die after 7 years, what happens to the income the next 3 years, or do you have does a beneficiary receive the money?
So almost all annuities at this point are going to have a beneficiary. How those 3 years are paid out to the beneficiary is really going to be determined by
by the annuity that that person is in, by the product they purchased. You know, a lot of it depends on what riders they might have purchased or how those guarantees were written out. I think in that scenario, I would assume that the beneficiary would at least get those 3 years of extra payments, but you'd really want to work with the annuity company to run those scenarios out also.
And what role does a Top Hat 457B plan have in income planning during retirement? How is it best used in spending? So 457B.
So the 457B plan is an additional account that's available to some employees to save more. And those dollars have rules for distribution. So without getting into too much details about the 457, when somebody retires or leaves MCW, they need to make an election on paying that money out. They can delay it all the way until 72 and start taking distributions then, or they can start it right away. The best, I think that that's a really specific question to that person, but what I would say is that the 457 can be used really well to supplement income in retirement, especially if you're under age 72 and not having to take required distributions yet. If it allows you to retire early and supplement your income, or allows you to provide income before you start taking withdrawals out of your accounts, I can see that being a good thing. I think equally important as a financial tool, talk with your tax person about the best time to take those withdrawals too, because you want to try to take those withdrawals or start them in years where you're taxed a little less. But
And I
for
know
that
we're
person,
past, sorry, Michael. I
no
know we're
problem.
past time here. We have 2 more questions. I believe I've caught all the others. And last 2 are, is there anything we should do in anticipation of hyperinflation? So similar to the first question we had, we don't know what's going to happen with the market. Well, now we're, similar area of hyperinflation.
Yeah, I feel like I'm still going to rely on the old balanced portfolio and invest for the long term. Even in periods of hyperinflation, there will be areas of the market that are positive and that grow over time. Yes, if we experience rising costs, it's going to be harder for companies to make earnings, but I don't think it'll be impossible. And there's always going to be industries that excel. So yeah, I think having those annual meetings, investing in things that you're comfortable with. There are inflation protected investments out there also if you're very concerned, but having a balanced portfolio and just riding the markets out has proven to be a successful strategy historically. So I'm going to stick with it.
And I think we covered this one there. There's no charge for your services, even if they've retired from MCW, correct?
Correct. Yeah, there's no charge to talk with me, no charge to talk with the Transamerica Advice Center. If you leave your money in the plan, there wouldn't be any major change or costs or expenses at all. And you could talk with me as much as you want.
And then most retirement advice that they've experienced in the past they've been told to hold off to tapping into Social Security until they reach their full retirement age. They hope to retire sooner than that. So in that case, should they use their retirement investments and annuity as reliable income resources to cover health care, other expenses until they reach full retirement age?
I don't think I'm going to be able to answer that in the time I have here. I feel like the general advice is to delay Social Security as long as you can to get the most amount. But once you start talking about withdrawing your accounts or relying on other sources, that becomes really specific to that person. A lot of it, I think, would depend on how much they have saved. I'd never want somebody to spend down a big portion of their assets just to delay Social Security. That would usually not make sense. But if they have a lot of money saved where it wouldn't really impact them too much, by taking out and delaying, it might be worth it, especially if they're planning to live, well into their 80s. That's always
Yeah,
the wild card.
we did have a Social Security presentation earlier in the month. It was actually last week on May 20th. I'm happy if somebody wants to email me, or you can email wellness@mcw.edu. I can send you that Social Security presentation. There was some touch points in that presentation on, the pluses and minuses. Like you said, Michael, it's very personal, and individual. So that person has to make that right decision for that situation.
Yeah.
And
And
for everybody,
Transamerica,
it can be different.
yeah, it can be different. And Transamerica does have like an optimizer, so we can plug that person's numbers into our software and pick different ages of taking it and see how it changes, the future numbers really. So we do have a way of figuring that out, but there's a lot of variables for a call like this today.
And Mark, did you have any other questions that you saw in the chat or Q&A? I just want to make sure.
No, I did not. I thought you were going to miss one, but you caught it, so I'm good.
Okay. And with that said, I think we got everybody's questions today. Our next and last session is on Thursday, all about long-term care, and that's at noon as well. So thank you for joining us today. We hope you're finding these sessions helpful. I will be sending information, the slide deck and the recording to all of you that attended the session, just so you have it as reference. And we hope you have a great afternoon, and thanks so much for joining us today.
Thanks, everybody.